Hi everyone, live as usual. I'm here. I know I have been missing Thursdays because, well, with the live TV, the other I had a flu. But anyway, here I am, and here is the market after Brexit. Indeed, something not me, not you. I don't believe not much, not many were expecting, right? The market has the pound plummet, whopping 1900 pips, 1,900, and the market is all about the Brexit. We have today a bit of a pause in the risk-averse environment, and the dollar, the yen, the gold had pair gains, right, and are currently retreating a bit, but if you read the article I wrote last Friday, I'm really convinced that this is just the beginning, and we are going to see a lot more of risk-averse trading in the upcoming days and months, even because there's a lot going on, and I believe that this is the beginning of it. And then really, I can't see how the euro area can stand as it is today without Britain, right? You know that countries will be part of the euro area, right? And Britain was among the one paying. I believe that Britain will represent 0.5% of the European GDP, right? So there we have the first problem. We are going to get a lot of negative figures from Europe if the Britain actually moves away from the euro area. The worst thing going on right now, I do believe, is that the euro area wants to be a member, better said, want Britain to leave as fast as possible. They have decided, well, now go, and I guess the idea is to survive, try to survive this bad moment, right? While at the same time, Prime Minister Cameron is in no rush to trigger the Article 50 of the Treaty of Lisbon, the one that created the region, and says, well, we can wait until October when we have a new Prime Minister. So what Britain is in no rush to exit, and I don't know, maybe they want to exit after referendum, who knows? But that's what seems to be going on right now in the markets. Anyway, I would start as usual taking a look at the economic calendar. To be honest, there's a bit more of macroeconomic data ahead, but anyway, the tension will remain 100% in the Brexit issues and jitters and all we are getting from there. But anyway, let me take a look and let me move the calendar in a few minutes, and I will be covering the new high. We have the US GDP latest release. You know that this is a quarterly figure that is released 3 times. We have 3 different revisions. The advanced one and the final one. This is the final one, right? So we are going to see the last revision of the first quarter US GDP. Market is expecting a 1% against previous 0.8%. I'm pretty sure we're not going to see much action today. Usually we don't with the last revision of the GDP unless we have a strong divergence from these readings, right? Something negative or something closer to 2%, which is pretty much unlikely. We are most likely see a negative number than a 2% because of how things are going on. And this is, I believe, the most relevant number we have today. We don't have much more to expect from the rest of the day. And we have this consumer and sentiment indexes tomorrow in the euro area, and inflation in Germany. They can give us a clue of the health of both, but are far from telling us or far from being able to move the market. Personal consumption and expenditure in the US could be a bit more inflation indexes than the Fed used to read, but still inflation seems to be a big issue everywhere. They're not going to see inflation up anywhere, and therefore there's little that this can do to the market. What should be interesting to see is the GDP figures in the United Kingdom, right? Another interest is next Thursday, but still I believe that the effects of the macroeconomic calendar, macroeconomic data, will in a couple of weeks, and I'm not putting much hopes that we are going to see interesting moves in the market these days, aside from any kind of Brexit notice, news, or whatever, right? And finally, to end the week, right, we have payrolls. Oh no, that's next week. Sorry, I was a bit. This is next week. So what we have on Friday is the market manufacturing PMIs, the flash readings. The first estimates the manufacturing sector for all Europe, right, and the US also. So an indication of the health of these economies, but be pretty sure that they won't be able to move much the market. I do expect some temporary reactions and those gains, losses being quickly reverted. Okay, let me change to charts. Sorry. I'm in the office, far away from home, right? Anyway, the euro dollar, I have erased this trend line, but I will put it again so we can talk about it. Give me a second. Weekly, this is November low. We have this as daily ascendant trend line. Okay, sorry. Let me just set a bit. Okay, here we are. The daily probably was between May and June and result in quite interesting bounces in euro dollar, I mean, right? But the Brexit chaos has made the pair break below it. And even if you take a little smaller time frames, like the 4 hours or 1 hour, you will see the price pull back to that broken trend line and resume its decline. What I'm also seeing here is that's for me, it's a quite bearish signs in the long term, mostly because if you take a look at daily, the pair has broke also below the 200 simple moving average, although it's struggling around it, right? Ever since the week started, we have been moving back and forth towards. What I'm also seeing is that the pair has 38% of this sharp decline can go higher. Maybe we can complete a 50% and another pullback to the trend line, but I don't see the pair rushing above this 1160, 1180 region anytime. Maybe we have news that really weaken the greenback, like payrolls, not this Friday, but the next one, or maybe admission of GDP. Well, then maybe we can see the dollar pulling back and completing an upward correction up to that region. But on spite the dollar, maybe not the one and the strongest currency to this being the Brexit pull. The fact is that segments really will continue and we could right for some short-term supports right around 1030, which is the 23.6% retracement of this, and where the price has held a couple of times over this past with the break below it exposing the pair to steady decline 69.20, which is the lows we get last Friday. Furthermore, and if I have, I guess you remember the 800 region, 840, right? And there we have multiple lows, weekly, daily, shorter, 840 could be the bottom of this movement during the upcoming days, not maybe this today, not maybe this week, but probably the next one. And that's probably bearish target for the pair. It has gained 1160, okay? Here again 1160, the pair can start correcting up to 1245 as the levels to watch. And at this point, I can see the euro 14. And when it comes to pound, well, we are at 30 years low, guys. You know, we have no records on this. I was going to last pointing around this level. So honestly, not much historical data as reference, but what I do have in here right? Let me find it. Okay, here is the 2009 low. We show it and not even complete a pullback. We have downward gaps. I don't see a trigger right now that can push the pair up to that 135, but it's like it's probably what the market will see right now as a line in the sand. Approaches to that level will probably be seen as selling opportunities, and a recovery above it, well, that may trigger enough corrective movement up to 14, but 140. Sorry, not 14, 40. But I'm still not seeing it go. And with the ongoing corrective movement, that will depend on how healthy or not is the U.S. economy with the upcoming data these days. To be honest, it could be triggered with the data. The immediate resistance right now is 3360, 3420, and the 3480 region, which is the highest we have for the week, early Sunday. So I'm expecting probably 45 region. If we don't, we'll probably fill the gap, and it's a nice 200 pips right in there, right? And the period in about 133 short. Ever since the long sessions, we have pushed near the level in Asia, retreat partially. So that's the immediate short-term support. If the dollar strengthens to either positive figures or risk sentiment resuming to 32 level to watch slow, and if somehow we break below it, I would expect it to fall farther below that 130, 115, and even approach to 130. Interesting is the Australian dollar. Of course, it has plunged with the risk aversion environment triggered by England, but it has held support, which is 73.30. It's the retracement of this year, right? Financial levels have been quite accurate, right? When it comes to large market moves, of course, not intraday, but they are quite representative of where market sentiment is. This bounce we are seeing today, the strong recovery, despite stocks are not doing that good, and commodities remain under pressure, and the rest of the majors are barely easing against the greenback, suggests that the Aussie is still bullish, right? And the market is waiting for dust to settle to revive the currency and probably push it back towards the 76 region or higher. Of course, I do believe that it will take right? It won't be today, not tomorrow, but the first 74.15, which is another also this year's rally and level to recover to see the pair strengthening further, right? Further. In that case, 75.20 and 76 are my bullish targets for this week. On the other hand, as I would say, in this 73.30 region is the key support, and if we have a 4-hour candle opening below the level with some dollar momentum, then I do believe that the risk charts south, and we can go first towards 72.50, right? Maybe below that, 72.50, and even closer to 72 later on. Okay, but overall, I do believe that the risk in here goes down quite immediate. When it comes to dollar to mention, well, it's clearly bearish, right? I read simple moving average in the weekly chart, right? Quite relevant. And well, in the daily, you see that the bearish trend is quite strong, quite alive. Corrective movements stall below previous highs, and prices being run towards the 100 simple moving average, right? If I told you the bank, the investors' speculative interest reached the 105 level, which was the line in the sand for the Bank of Japan. At this point, I do believe that to test the 100 level and push it that low, particularly if the risk averse and move stocks recover intraday, we may see some upward corrective movement. But anyway, right now below 105, it's bearish for me, and any kind of upward move, I would probably take it as a reason or a good opportunity to sell. Okay, shorter term, let's go to intraday more view. The fact is that there's not much going on in here. Tight ranges, little definitions, an immediate support around 100, 118, the other one at 113. I would like to see a pair below 100, 1.10, right? That's the level I'm looking for to confirm a slide down to 100. I don't know. I'm not seeing yet clearly how the pair would reach 98, 80 again without the Bank of Japan trying to intervene, talk, inject stimulus, whatever, right? They will try to do whatever it takes. For now, that's just comments, and so when we are near a test of 100, but not much more lower, because the Bank of Japan will probably do something. Of course, this low, the Bank of Japan will do anything because of the negative momentum of the market. We need the pair to settle before trying to buy it again, right? I believe that, yeah, everything's working, sound, everything. Okay, sorry, it was just checking. 102.60 is for me the level to watch. Above it, we can go up to 100, 340, 50. I'm not seeing the pair rising much, but if we do, the highest I can see it right now, as I told you, is 105. So some consolidation beyond 100, 340, 60, that will lead us to a recovery up to 105, okay? The other thing I'm watching, not really, but I'm watching, is FXStreet, right? It's the Dow Jones fell yesterday and it's to 17,000.51, and the S&P flirted with the 2,000 level. In fact, it fell a few points below it before recovering. Today we are seeing a positive tone ahead of the opening, but there are too close psychological levels that I do believe that if they are taken, will feel the risk-averse sentiment across the board and therefore affect currencies. Of course, favoring the dollar and taken anyway, because 2,000 in here and 17,000 in here are critical levels, and we'll probably see them plummeting. When it comes to gold prices, this rally yesterday, but Eastern sentiment today is putting it back under some downward corrective move. Anyway, we're standing above 1303, which is the former high, right? So I don't see any relevant downward corrective movement taking place as long as we hold above that one. I do expect some buying interest to surge if we approach this level today, right? It's not just about risk aversion. Keep in mind that also, I forgot to say that before, the fact that the area, right, will probably mean economic slowdown all across the world. Yes, we won't be able to raise rates this year, right? We'll have to stay pat and wait maybe for next year, likely. So with the Fed out of the picture, gold has room to continue advancing, right? I'm not saying it at 1,500 or something like that, but probably approaching to 14 seems likely. Moreover, if risk resumes and the dollar remains weak, and the US data came out negative, telling us that the Fed rate hike is farther away, right? And when it comes to oil, it plummeted yesterday, but I believe that was mostly on broad dollar strength, right? we tested our approach at 45, 45.80 was the low in my charts. I believe I told you a time ago that the bullish tone is there, the commodity, I can see it rallying strongly beyond 50, $52 a barrel. That's sort of a ceiling, right? But I don't see it either falling back below 40. In fact, I believe that we have sort of a floor between 42, 60, 43, let's say 43, 45, right? That should be sort of a, ever since the year started, we have had news of diminishing stockpiles, diminishing pumping oil rates, and price going a bit faster. The problem in here is that how much affected the global demand of oil during the second half of 2016, right? We are 3 days away from that date. Anyway, for the most, 43, 45 seems to be a bottom, 50, 52 seems to be a top in here, right? And of course, it will probably continue, but I do believe that the correlation will be a bit more limited. Okay, guys, don't place bets in oil just looking at what's going on in the rest of the market. Remember, the correlation is not as strong these days. Okay, I believe that's with the coverage of the live coverage of the US GDP last revision. So see you in a few minutes. Okay, thanks for being here and see you soon. Bye bye.